Hey, Jenny, you have to take away 7 unique options. I don't think I have that many. Hang on. Stand by. Are you struggling to get pre-approved because you're not sure about your income, your assets? Something about your paperwork just is not right. Did you know that there are solutions for you? That's what we're going to talk about today. We're talking about alternative loans. I've got 6 to 7 different alternative mortgage loan options for you. So we're going to go through each one. And I really want to hear your all's questions today because there's so many scenarios out there. In fact, just in the last 2 or 3 days, I've had several scenarios. So if I don't have any questions with certain scenarios, I'll go ahead and give you some, but let me hear your questions. Comment. We're watching behind the scenes to make sure I answer questions, and we're streaming on all platforms today. So this will be super fun. The first thing I wanted to explain so that you can understand, that's why I like real facts, no BS. I like to just give it to you straight. The first thing I want you to understand is think of mortgage loan documentation. Think of them as lanes on a highway. And there's really 6 to 7 different lanes, and there's deviations and there's exits. So the first lane and the fastest lane, the one that you can do the lowest down payment, you can do the lowest interest rate, that's always going to be your full documentation kind of a loan. Easy story, full tax returns, W-2s, everything fits together. You've got bank statements. You don't have weird deposits. Everything's just kind of fits in a box. Well, that's okay unless you don't fit in the box. So that's what we're talking about today, alternative loan documentation. So that's one lane of the highway, and that's really kind of the fast lane to get the lowest down payment and the lowest interest rate, okay? So if you're in that lane, congratulations, very good for you. But there's a lot of people that aren't. You just have too many deductions on your tax return, or maybe you haven't filed in a couple of years because whatever reason. And these are usually people that are self-employed. And self-employed means that you run your own deal, you earn your own money, and you also deduct expenses. You know, on your tax return, you're either Schedule C, maybe you have a corporation, LLC, that kind of thing. So if that resonates with you, that's who I'm talking to today. The W-2 person, everything's pretty straight, cut and dry. Your income is kind of what your income is, and it's guaranteed. So we take it as that. So alternative documentation are some alternative solutions. Now, I will say on those other lanes of the highway that we talked about, things start to get a little bit deviated, right? So another lane, if these loans, by the way, the lanes in that fast highway we talked about, that's usually the conforming Fannie Mae, Freddie Mac. That's what conforming is, or FHA, VA, you know, those types of mainstream loans that like 70% of the people get. So the other loans are called non-QM loans. What is a non-QM loan, Jennifer? It stands for non-qualified mortgage. It came about back in 2010. Many of you might remember the mortgage meltdown. Some of you aren't old enough to remember it, but it happened. And it was when the industry of loans took a huge recalibration. There were all kinds of funky loans going on. I remember the names: Fast and Easy, Streamline Accept, you know, there was a no doc, no nothing. Like you could be breathing and have a credit card and get a loan 100%. Like it was crazy nuts. Now things aren't that crazy as they were. Lessons have been learned. But in the past, what happened then is they said, okay, loans are either qualified mortgages where they fit all this income and documentation criteria. And if they don't fit that kind of a loan, it's called a non-QM loan. So today, that's what we're talking about, the non-QM loans. So again, let me hear your questions. Let me hear your scenarios. I'm happy to answer today. So non-QM loans are where these full documentation loans sit. So the first thing to understand is that it usually will require more down payment and a higher interest rate. That's just the bottom line. There's lots, not lots, but there's a good amount of investors and banks out there that do these loans. So there's some different guidelines. I'm not going to get too nitpicky today into the guidelines of, I'm going to give you some generalities. For the most part, definitely 10%. And in many cases, you need to just expect 20% down. Just remember, the more that you put as a down payment, the lower your interest rate will be. What does that mean by higher interest rate? They're anywhere from 1 to 3% higher than what the mainstream loans are getting. But it gets you in the house. You can refinance later. If it's your primary residence, there's no prepayment penalties. So these are some of the good things about these alternate documentation loans. So that being said, the first one that I want to talk to you about, which is really the one that's kind of most like a full doc loan that's really popular, is a bank statement loan. Can we use bank statements to qualify? The answer is yes. Bank statement loans sit in that non-QM category. Remember, alternative documentation. And I tagline this kind of weird loans. Like, these are just, you've got weird documentation. You don't fit the box. You're not in the box. That's what this is. So a bank statement loan usually comes in either 12 or 24 months, minimum at least 12. We want to see that you've been employed, self-employed, that you've had a business for 2 years. Now, 2 years is the key in lending. We're going to rely on your CPA letter. Your CPA is going to have to get involved and attest to some things. They're a third disinterested party professional, and we know that they're not going to risk their their license to make anything up. So we need to confirm 2 years in business at least. But then what you do is you take your business tax returns, your business bank account statements, and you submit them. We take the deposits. We take 50% of that, assuming a 50% expense ratio. Now, there are some divots to this loan. I want you to understand just some things, some kind of pros and cons. The pro is hopefully it's really easy. It shows deposits. A lot of business owners have some healthy deposits. It just doesn't show that way at tax time when it comes time to deducting things. The thing you need to watch out for on the bank statement program is, number one, we really look at deposits coming from all these different sources. Obviously, we're not going to count deposits that are from some of your own accounts. They can't be like self-generated deposits from another account. And also, it needs to be pretty clear that you have kind of a 1 or 2 sources of income. Like, if you have 3 different bank statements, it's going to be really hard to do this. It's going to be very tricky. We're going to probably want to rely on just the main bank account. So it can get really tricky. So make sure your records are really clean, simplify things. If you're running a business, if you're running everything through your personal accounts right now, you really want to separate things and have a separate business bank account. Even if you're a DBA, even if you're an LLC, just a sole proprietor, it really makes sense. It's going to make things easier later on, not only for your accounting, but for future loan approval. Okay, so these are bank statement loans. Now, if we use your personal bank statement, we're going to take just your deposits into your personal account. Now, we are going to check the source, of something that we think is recurring deposits. Most people will transfer money from their business account, pay themselves a draw each month, etc. Now, this loan, it is important to know, credit really needs to be in the 700s. I mean, is there available for 660 down to 660? That's kind of the minimum on these alternate documentation, what I call weird loans. Weird because they're out of the ordinary, right? It doesn't mean you're weird, y'all. So it just means they're weird. They're different. Credit really is the key. The 2 keys in any of the loans that I'm going to talk about is credit. Hopefully you have a 700 plus. Now, you want to check out some of my videos on my YouTube channel. I've got a whole library of credit videos. We'll put some links in the description on credit and how to get your credit up. But 700, really 740, 760 is the mecca of all this. But you can get things done with above 700. You can even get it done with a 660. It's just, your rate's going to be higher. The other key is reserves. So reserves in these kind of loans, because we're basically like turning our head and ignoring the fact that we know that you probably don't claim this income on your tax return. Like, we know. Why else would you do this kind of loan? So reserves, showing that you have money to fall back on, is really, really crucial. This isn't money that has to be spent, but it's money that's like in a 401k, in something that's relatively liquid. It can't be money in another property. It can't be money, usually oil and gas leases, stuff like that. It's too hard to extract if you've gotten in an emergency. So something like mutual funds, stocks, again, it doesn't need to be spent, but it usually needs to be at least 6 months. Some programs are 12, but at least 6 months reserves of your monthly payment. So if your monthly payment with tax, insurance, principal and interest, and prorated HOA dues is $3,000 a month, you take 3,000 times 6, that's 18,000 that we need to see somewhere just sitting there as reserves, to know that you have some gas in the tank, to where if you have a financial little blip on the screen, you can tap into something to make your mortgage payment. Okay, that's what reserves means. And that's really crucial on a lot of the loans that we're going to talk about today. So if you have questions about bank statement loans, if you think you have more questions about that, let's hear your comments, y'all. Let's hear what's going on. So those are bank statement loans. Those are usually have better rates than the other ones that I'm going to talk about. The next kind of a loan is a profit and loss loan. It's where we actually have the CPA do a profit and loss for you. And it's not a calendar year. It can be May to May, June to June. It's actual, any time of the year. We look back a year, and we're going to rely again on the CPA to write a letter and attest to the fact that you've got at least 2 years in business functioning, and that this is kind of an accurate and true profit and loss statement. And they're going to put your deposits, and then they're going to put your expenses, and whatever the income is at the bottom is what we're going to use. And we're going to divide it by 12 months. Okay. That's a P&L loan. Again, that's like getting super, super creative. When would you use this kind of loan? You would use it if your 12 months bank statements you might be the person where you've got deposits all over the place. You've got 2, 3, 4 accounts. It's just not clean. A P&L, profit and loss statement program, could be for you. It just kind of cleans all that up. It involves a CPA, and we rely on CPAs for a lot of this stuff, because we know that, again, that they're not going to put something on paper that's not accurate. They're going to be like, hey, I'm attesting that this guy makes money. It's not an audited P&L, but it's like, hey, this is pretty accurate from this May to May time period, for example. So it's usually probably used for that person where the bank statements just don't tell the story, because you've got money coming in all directions, and it's hard to streamline it so that it's easily able to be analyzed. That's probably what's going to happen. Again, reserves, credit score, down payment 20%. That's going to be required. Okay. Now there's another type of a loan. So 1099. Let's talk about 1099, because there's some misunderstanding about 1099. So 1099 is when you're paid by an entity and you earn from them more than $400 a year, I think is the IRS number. You need to be 1099. So like, I have a few people on my team that are contract. They're not employees, and they work, 15 to 20 hours a week for me. And at the end of the year, I will pay them a 1099. I will report it. I'll put it on my tax return, all that kind of stuff. So if you're a recipient of a 1099, but your tax returns aren't quite right, or you don't want to fool with it, or whatever the reason, we can take last year's 1099 that you've received from this one entity. There's a lot of you out there that work for a company, and they're your only source of income. You're like a consultant, or you're an engineer, or whatever the reason. And we use that 1099 and we take that as your income. Now, there is a little bit deducted for expense. But this is a really good option for people that, I mean, 1099, you're really not always really running your business, because the people that are sending you the 1099, they're the business owner and you're just working for that one entity. So there's a lot of 1099 people out there, and 1099 stands for a form that the IRS uses. It's called Form 1099. It means you're not a permanent employee, you're a contract type employee. So there are some, now that one is actually pretty lenient, um, in the way that you can probably put 10% down on that one, and the interest rate's not too bad. It's not as creative as like the profit and loss program, for example, but it is out there. So if you're 1099, this could be a good program for you. The other type, in fact, I just had this inquiry yesterday. He's got lots of money in the bank, like over 3 or 4 million, that's pretty liquid. And he just doesn't make monthly income. I mean, he does, but it's not really, he just sold his company. He's now on a retainer. He's only going to be paid for 3 months to get the new company, new owner off the ground. Like, his income is just not straight and forward. And it doesn't fit that box that we talked about. But dude has money. He has assets. So assets are queen and king of the universe, y'all. Assets talk. So what we can do is we can use a formula that lenders use. We say, hey, these are the liquid assets. And I'm not talking about assets in property. Like, it doesn't count. Like, a life insurance policy for $2 million doesn't count, because the only way you can access it is dying. So we definitely don't want that to happen. Now, we could possibly count cash value of it, but what I'm saying is it's a pretty liquid asset that you could get your hands on it pretty quickly. So we take that number, whatever that is, let's say it's 2 million, and we reduce it a little bit, usually by 30, 35%, to allow for market fluctuation. You know how that goes. And then we divide it by a certain number. Like, there's some investors that I have that are 240 months. I've got one who's super aggressive, and they only divide it by 60 months. Like, that's pretty cool. That's only like a 5-year scope. So there's some really interesting programs out there. So I'm going to pause for a second and tell you how all this came about. So when the mortgage meltdown happened, everyone put on the brakes. Everything was, you had to be super squeaky clean and fit in this box for a few years. And little by little, over the last, let's see, 2010. Oh my gosh, that was 14 years ago. So little by little, I've seen these investors will come out, these little private money investors that'll get together and say, hey, we're going to loan to people under this criteria. So in the last, I would say in the last 2 years, 2 to 3, we've seen this evolution of things getting a little bit more creative and a little bit more creative. Now, they're definitely not as creative as they were back when I was doing loans I've been doing this since 1998. So 2005 was just cray cray, y'all. I mean, you literally could be breathing and get a loan. But lessons have been learned. Things are creative, but still within a certain structure. Okay. And these things are here for a reason, and it's super cool. It's super cool. And it really allows some of you to have some really good solutions. So I will say that if you can't do the profit and loss, you can't do the bank statement. I mean, sometimes there are people where none of these things are a fit, and you don't have a ton of money, like my $3 million client. Sometimes it's just not you. There are, I like to call them no ask, no tell loans, because they really are kind of that. You have a 20% down payment, you are breathing, and you have to have good credit. Now, these loans are not for the faint of heart. However, they do work for some people. You could call it a hard money loan. True hard money loans, we're going to talk about investors in just a minute. True hard money loans are really for investors. But this is the primary residence, hard money loan equivalent. I call it no ask, no tell. You put 20%, or actually you have to put 20, the one I'm thinking about is 25% down. So you have to be super squeaky clean. Okay. It's probably 3 to 4% above the interest rate's probably 3% above whatever the market rate is. And you're paying like 3 points. 3 points means, let's say it's a $300,000 loan. 3 points in closing costs is 3% times 300,000. It's an extra 9 grand in just fees. Now, some of you, I know what you're thinking. You'd have to be stupid to take that. Not always. I mean, I could debate a whole other day. In fact, we'll do another live about the reasons renting is not for everybody. I know there's some of you watching TikTok videos and you're like, oh yeah, don't rent, take all that money and go invest it. And, I'm all for passive income, don't get me wrong, but that's just not for most people. There's a lot of things to be said about not renting and living in a home. So home ownership is the American dream. It builds communities, it fosters commitment, it builds good people that are committing and contributing to society. There's all kinds of things we could debate about. But the bottom line here today is there are some solutions for people that this could possibly work. Okay. And that is that 25% down, higher rate and higher points, but it does work for some people. Now, the last thing we're going to go over for you investors out there, what I call these alternative weird loan documentation. Investors are investing. They're using their available cash to invest in more property. I've really met in my years and years and thousands of loans financed, very few investors that have a ton of cash laying around. The money's in their property. The equity's in their property. They're cash flowing. They're making smart decisions. So some investors on paper, their tax returns, they're a hot mess, y'all. Hot mess is only how I'm going to explain it because they have 1,000 deductions. It's creative. It's all these kind of things going on. So a great loan that really is not that much more expensive than a regular good old investment property loan, conventional conforming, is a DSCR loan. Now, DSCR, really important. You can only use this for investment property. You cannot use this if you're going to live there. You cannot. It's only for investment property. You have to put minimum 20% down. But I will say the catch to this loan, because DSCR stands for debt service coverage ratio. Debt service coverage ratio, meaning you're going to use the income from the rental property. So the income coming in, let's say you're renting it for $2,500 a month. Your tax, insurance, principal, and interest, your full payment, prorated payment for this property has to be the same as the rent, which in this case is $2,500 or less, of course. There are some exceptions. There are some exceptions, but let's just stay with the 1-to-1 ratio for a minute. In certain states, like the one that I live in, Texas, property tax and property insurance is high. I'm just going to be frank and transparent with y'all. We pay no state income tax, and this is our, I don't want to say punishment, but it's just our reality. So meeting that 1-to-1 ratio is really hard. You can't do it with 20% down. So usually people in this market have to do 30, 35% down. It all depends on the tax and insurance and how that whole, payment, PITI, is calculated. But this is a really cool loan. And sometimes my clients, they can prove income on their tax returns, but the rate is so similar. They're like, why wouldn't I just do the DSCR and be done with it? Like, we could do interest only. There is on investment property on the DSCR, there is a prepayment penalty, but we work through that. You can buy it out. Like, there's ins and outs of it. Okay. It's not always the best option, but a lot of investors do not like to come up with a bunch of paperwork because they have complicated backgrounds. They own a gazillion properties and they're like, you mean I got to get tax and insurance and get you leases on all these 23 properties I own? Are you joking? I'm like, sorry. So This could be a good solution for some of you because really we just want your primary residence. Really, we just want your primary residence and the property that we're financing. We don't even care that you put all those other properties on there. So that's a pretty cool property for you investors out there. And the last one really is the hard money loan for investors. Now, I did a live last week, so you'll want to check it out on hard money. And I interviewed just last week a hard money lender, and we went through tons of information. It was like a 30-minute live, ins and outs of hard money. So you want to check that out. I streamed it. It's on YouTube. It's on Instagram. It's everywhere. Hard money. So this really concludes our unique loans. If you think that you qualify or that you don't qualify because of one of these reasons, talk to a lender. If you're in Texas, just DM me, call me. I'd love to help you, or I can point you in the right direction. But talk to someone in your state because the different states have different ins and outs. I really am a proponent of talk to someone in your state type lenders that has a lot of unique solutions. Not every lender carries all these programs. So that's really important for you to understand. But I thank you for joining us today. And these are some really cool solutions for people. And I just want you to leave with this: down payment and securing your credit is the key. So you want to make sure to watch my videos about credit. I've got lots of videos on my YouTube channel. Just go to my credit playlist on how to get that credit intact, because that is crucial. We'll talk to you soon. We'll see you next week. Next week, we're talking about land loans. So Thursdays at 2. I'm live every Thursday at 2 Central. You want to check it out. We're interviewing a banker on land loans. It's going to be super impactful. Thanks for joining. We'll talk to you soon.